When you hear the tone, you will be the 160th person to join the meeting.
Okay. We'll wait for that. This is Ralph Cortez. I am a Content and Products Manager for the Business and Commercial module of Lexis Practice Advisor, and also one of the contributing authors. It's my pleasure to welcome you to our program, Choosing a Business Entity, What's the Right Fit for Your Client. Just a little background on myself. I began my career at Morgan, Lewis & Bockius, where I was a member of the Banking and Financial Restructuring Group. I then transitioned to Weil, Gotshal & Manges, joining their Banking and Finance Group and focusing on distressed lending, structured finance and derivatives, cross-border transactions, and general commercial lending. Today's program is going to cover the most popular forms of business, including sole proprietorships, general partnerships, limited partnerships, limited liability partnerships, corporations, and limited liability companies. We'll talk about the pros and cons of each form of entity, and I'll guide you through the process of advising your client on the best form of entity for their business. We'll have some time at the end for a Q&A, so please hold any questions until the end of the presentation. Okay, we have a lot to cover today, so let's get right into it. Where do we begin when advising a client on the best form of entity for its prospective business? There are three basic questions that must be addressed before we can make a determination of what the best fit is for your client. The three questions asked cover 1, liability, 2, cost, and 3, control. A major concern when choosing a form of entity is the extent a business owner is personally liable for the debts of the business or for any judgments against the business. Unless liability is limited by the entity selected, the owner's personal assets are at risk if the business fails or is successfully sued. To help you determine the best choice of entity, assess your client's risk of liability. So for example, if the business owns property, several employees, the probability of a lawsuit is higher than with a small personal services business that does not own property and does not have employees. Your client's appetite for dealing with legal paperwork and statutory formalities also factors into the liability analysis. Generally speaking, the entity choices that are easiest to form and maintain offer the least amount of protection, while the entities that involve more paperwork and are more expensive to form and maintain offer the greatest amount of liability protection. Liability insurance is an option. So if your client chooses an entity that offers little protection, liability insurance can be purchased to cover certain claims, but the cost of the insurance and the extent of protection offered by it must be weighed against choosing an entity that offers more protection. The cost analysis when choosing a business entity involves considering 4 factors. 1, entry costs, or how much it costs to create the business and get it running. 2, maintenance costs. 3, taxes. And 4, the cost of raising capital. Start with looking at entry costs. Incorporation costs can vary from almost 0 in the case of a sole proprietorship to thousands of dollars. It's important to stress to prospective clients that while they may undertake the incorporation process themselves, hiring an attorney that specializes in starting businesses to ensure that all the necessary paperwork is completed and filed correctly. Entry costs can further be divided into 4 categories. The first category is state filing fees. While the default business types, sole proprietorships and partnerships generally do not need to make any state filings, LLCs and corporations are required to pay a fee when filing their articles of incorporation. Filing fees vary depending on the state of incorporation and the type of entity, but typically will range from $50 to $200. Fees for designating and maintaining a registered agent in the state must also be paid. Second, we have federal filing fees. In most cases, the federal agency charging fees will be the IRS.
Can you go get the charger for this phone, please?
For example, The IRS charges processing fees for a determination letter when applying for tax-exempt status. The third category of entry fees includes licenses, registrations, and permits. Most businesses that operate or withhold employee taxes in the state must obtain a business license from that state. These licenses must be renewed periodically, and a license fee must be paid. These fees vary depending on the type of business and the number of locations the business has. And finally, there are a handful of states that require the publication of notices for certain types of entity filings. The notices are supposed to protect the community by alerting them to newly formed businesses or to changes in existing businesses. So using New York as an example, New York imposes a publication requirement on domestic and foreign LLCs, limited partnerships, and limited liability partnerships. Notices are required for 3 types of filings: formation, conversion, and qualification. To meet the requirement, the entity must have 6 consecutive publications in 2 newspapers, one being a daily paper. The costs of publication vary between counties in New York, but can range from $300 to over $2,500. Not surprisingly, New York's publication requirements have really been criticized, with critics saying it's completely outdated and archaic. Nonetheless, it's still law in New York, and there is no way around it, aside from incorporating in another jurisdiction, if that's even an option. The second cost factor involves maintenance costs. So for example, sole proprietorships and partnerships do not have any recurring maintenance costs aside from renewing any licenses or permits they need to operate legally. LLCs and corporations, on the other hand, must include in their budgets the annual costs of keeping their entities in good standing. The maintenance cost analysis should first start with looking at upfront costs versus long-term costs. In some cases, forming a corporation will initially be less costly than forming a complex LLC, but because corporations are required to hold annual board and shareholder meetings, over time, the maintenance costs will be more expensive than in LLCs. Maintenance also involves filing annual reports or reports of information. Corporations and LLCs are required to file an annual report or statement of information with the Secretary of State, both of which involve paying a filing fee. In Delaware, even though Delaware LLCs are not required to file an annual report, all LLCs in the state must pay an annual business entity tax of $250 by June 1st of each year. The third cost factor is usually every business owner's least favorite part of owning a business, and that's paying taxes. The form of business entity chosen will determine the type of income tax return that must be filed and the amount of tax that must be paid. Naturally, business owners will want to minimize their tax obligations as much as possible. Business entity taxation can be divided into 3 general categories. The first category is taxable entities. A taxable entity pays income tax on its profits as if it were a person like you or I. In addition, the owners of the taxable entity pay taxes on any distributions to them from the entity. And this is the concept of dual taxation. The second is a pass-through or conduit entity. With pass-through entities, income flows through the entity without being taxed and is treated as the personal income of the owners, thereby avoiding dual taxation. And third, we have not-for-profit entities. While not-for-profits do not have complete tax immunity, they are exempt from most state and federal taxes. So far we've covered entry costs, maintenance costs, and taxation costs. The fourth and final cost factor is the cost associated with raising capital. When choosing a type of entity, the business owner should consider whether they will be seeking outside financing and the type of financing that will be sought. Let's look at some examples. General partnerships are typically limited in their ability to raise capital from outside investors because each partner has personal liability for the obligations of the partnership. In addition, an investor might find it difficult to sell its investment because there is usually a limited market for the sale of a partnership interest. Although their prospects are improving as they become more and more popular, an LLC's ability to raise capital is also limited. When compared with a corporation, an LLC typically has a harder time raising outside capital. This is because the corporate structure is well known and more easily understood than the structure of an LLC. Moreover, venture capital funds generally prefer to invest in corporations. Later on, we'll talk about the best entity choices if raising capital is a concern. The final major factor to consider, in addition to liability and cost, is control or management. When more than one person is involved in a business, you must consider whether all of the owners will participate in the control and management of the business and in what form. Answering this question would then help you decide which entity to choose. The key driver in the control analysis is the ownership structure of the business. Some questions to ask include, who will own the business? Will it be one person, a few people, many people? Will there be corporate owners, i.e. venture capitalists? Will ownership remain the same, or will owners come and go? Without taking into account liability or cost factors, the number of owners determines the type of entity that may be chosen, so you can essentially eliminate certain choices based on the number of owners alone. For example, a business that will have a single owner can choose to operate as a sole proprietorship, a corporation, or an LLC. By definition, if the business will be owned by more than one person, it cannot be a sole proprietorship. Similarly, a business with only one owner cannot be a partnership. It is important to remember that a business's control structure is important for both external and internal reasons. Transparency in control structure is important for dealings with outside third parties. For example, the basic management structure of a corporation is well known to and easily accepted by outside third parties. LLCs, on the other hand, are a relatively new type of entity, and LLC case law is not as well developed as corporation case law. Equally as important as relationships with outside parties are the relationships between and among the business owners and management themselves. For example, the LLC structure provides a high degree of flexibility with respect to control structures and allows the owners to customize the way control is distributed. An LLC may be managed by its members, by one or more managers, or any permutation in between. The flexibility of an LLC allows owners to structure control as loosely or as rigidly as they like. Before we go on, just two quick reminders. Choosing the right type of entity involves balancing many advantages and disadvantages, and there will not always be a clear winner or definitive correct choice. In fact, because businesses mature over time, the ideal choice of entity may change over the course of a business's life cycle, in which case you may choose to convert to a different entity. Also note that this presentation focuses on the characteristics of business entities generally, and as each state may differ in its approach, counsel should be sure to research the specific rules of the jurisdiction of incorporation. With that in mind, let's take a closer look at the options available. Starting with sole proprietorships, the first step is to talk about what it is. A sole proprietorship is a business that is owned by one person who is called the sole proprietor and is the simplest form of business. The sole proprietorship is one of the most common types of business entities due to the fact that it is one of the easiest entity types to establish and because it is relatively free from government reporting requirements and regulation. Let's look at liability. The key disadvantage of a sole proprietorship is that forming and operating a sole proprietorship does not limit the liability of the sole proprietor in any way. You assume full personal liability for the debts of the business. Therefore, forming a sole proprietorship is not very desirable unless your business is extremely low risk. Even if the activities of the business are considered to be low risk, a sole proprietor may wish to consult with an insurance agent to discuss how to properly insure the business as well as any personal assets, because everything the person owns is at risk. Turning to cost, we find out that the cost analysis is mixed for sole proprietorships. A sole proprietorship is the most simple and formality-free form of business, and formation costs are extremely minimal. There are no state filing requirements other than obtaining any necessary licenses or permits. There is no risk of double taxation because all flows directly to the sole proprietor's personal income. There are also no rules governing how the business can be transferred or wound down. However, although entry costs are minimal, a sole proprietorship is by definition owned by one individual and thus cannot issue equity to outside investors. This raises the cost of securing outside capital because an interest in the business cannot be sold off. A sole proprietorship offers its owner maximal control of the business. Entity choices, the sole proprietor enjoys the most flexibility, freedom, and control over its business. So taking a look at the scorecard, which basically sums up everything we just mentioned in a quick chart, we see that sole proprietorships get a negative score because of the unlimited liability, because it's cheap to form and maintain, but raising capital can be expensive, and a positive control score because the owner can basically do anything he or she wants. Bringing it all together, a sole proprietorship would be a good choice for someone who is looking to start a one-person business quickly and at a low entry cost. Their business should not have excessive outside investment needs and should be extremely low risk. A real-world example of a sole proprietorship would be an accountant, assuming they could obtain outside malpractice insurance to limit their personal liability. Next, we turn to general partnerships. A general partnership is created when two or more individuals or entities agree to go into business together. A partnership can be formed by express written or oral agreement or implied by course of conduct. Although not required by law, it is recommended that partners enter into a written partnership agreement to memorialize their business arrangement. Subject to the terms of the partnership agreement, partners share equally in the management of the partnership business as well as its profits and losses. Similar to a sole proprietorship, the primary disadvantage of a general partnership is that each partner is personally liable for any debts incurred by the partnership. Although a partnership is a legal entity distinct from its partners, so may own property in its own right, partners are individually and jointly responsible for any liabilities incurred by the partnership. Therefore, operating a partnership in a line of business where liability is likely can be very risky. Although business insurance can be used to mitigate personal liability, many business owners choose an alternative form of entity despite the added formation costs and greater administrative requirements. Entry costs for a general partnership are low, and they are fairly easy to create and maintain. For example, in most jurisdictions, general partnerships, unlike corporations and LLCs, are not required to observe formal statutory requirements or procedures. Tax costs are also low, as a general partnership does not pay state or federal income tax at the partnership level. Rather, individual partners pay taxes on their share of the partnership's income. Although initial entry and taxation costs are minimal, a general partnership will have difficulty raising capital from outside investors. An outside investor will not want to be a general partner, thereby exposing themselves to unlimited liability. A general partnership offers considerable flexibility to the partners when deciding how business decisions will be made. The partners have a variety of options when dividing management responsibilities and will have to evaluate each partner's strengths, competencies, and weaknesses, which may be quite varied depending on the nature of the partnership and the individual partners. A general partnership offers similar flexibility when determining how ownership percentages will be allocated among the partners. The partners may agree to allocate ownership percentages based on any number of factors, including each partner's capital contribution, intellectual property contribution, physical property contribution, labor provided, as well as any number of things as long as the partners agree. So taking a look at this scorecard, we see that general partnerships score the same as sole proprietorships. They get a negative score because of the unlimited liability, a mixed cost score because while it's cheap to form and maintain, raising capital can be expensive, and a positive control score because the owners have maximal management and ownership control. Bringing it all together, a general partnership would be a good choice for 2 or more individuals who are looking to start a business quickly and at a low entry cost. Their business should not have excessive outside investment needs and should be relatively low risk. A real-world example would be similar to the sole proprietorship example, but now there are at least 2 people involved, so we're looking at an accounting firm instead of just a solo accountant. The next entity type is limited partnerships. Like a general partnership, a limited partnership is created when 2 or more individuals agree to go into business together. The limited partnership structure allows a partnership to admit 2 different types of partners, general partners and limited partners. Unlike in a general partnership, where there is a presumption that all partners have full managerial and contract authority, limited partners do not closely participate in management and do not have apparent authority to bind a business. In exchange for this reduced authority, limited partners enjoy limited personal liability for partnership debt. Depending on your role in a limited partnership, your liability will either be limited or unlimited. Let's first look at limited liability. The most attractive benefit of a limited partnership over a general partnership is that the limited partners are not personally liable for the debts and obligations of the limited partnership. In exchange for the willingness to assume a passive role in the day-to-day operation of the business, each limited partner is able to limit their risk of loss to the amount of their investment. For general partners, however, it's a different story. They remain completely vulnerable and may be held personally liable for the debts and obligations of the partnership. Turning to the cost analysis, we see that entry costs are high and tax and capital costs are low. Let's first talk about entry costs. Unlike a general partnership, a limited partnership is a creature of statute and therefore is more complicated and expensive to form. In addition, some states require that a written limited partnership agreement be executed. Finally, the accounting needs of a limited partnership usually require outside professional assistance. With respect to taxation, limited partnerships are pass-through entities for tax purposes, meaning that the business income of the partnership is taxed as personal income to the partners. There is no income taxation at the entity level. And finally, with respect to capital costs, a general partner will have a much easier time raising capital because investors may contribute to the partnership as limited partners, thereby greatly minimizing their risk. Furthermore, a limited partner may sell his or her interest in a limited partnership without causing the partnership to dissolve, making outside investment even more likely. A limited partnership gives its owners maximal control. The general partners control the business without input or approvals from the limited partners except as required by law or as set forth in a partnership agreement. This structure provides flexibility in the allocation of managerial control and makes the potential investment more attractive to those who do not want additional business responsibilities. The concentration of managerial authority with the general partner or general partners makes it possible to admit a substantial number of limited partners without rendering the business unmanageable. Taking a look at the scorecard, we see that limited partnerships get mixed reviews in terms of liability because the analysis depends on whether you are a general or a limited partner. There's a mixed grade for cost because while entry costs are high due to the complexity of the structure, low tax and capital costs are a plus. Finally, the control analysis is positive because the general partners retain full control of the business. Now, typically, when you have two categories of mixed scores, this is telling us that the circumstances under which the entity would be a good choice are pretty specific. Now, in light of those mixed scores, in practice, a limited partnership would be a good choice for a business in which there is a clear division between those providing labor and those providing capital. It would also be a good choice for a one-off venture or a venture that is limited in duration. A real-world example would be a real estate development project. Now, typically, an experienced property manager or developer serves as a general partner, and outside investors provide financing for the project in exchange for a share of ownership as limited partners. The next entity type we'll look at is limited liability partnerships. An LLP is a general partnership that, upon compliance with certain statutory requirements, provides limited liability for its partners. It's a business form most commonly associated with professional services such as law and medicine. Although not always required by law, a written partnership agreement, which is highly recommended nonetheless, is to define the rights and obligations of the partners. In the event no written agreement exists, default state partnership rules set forth the rights and obligations of the partners. Now, as the name implies, partners in a limited liability partnership have limited liability. And generally, a limited liability partnership is in all respects a general partnership with a huge caveat that it has made a filing with the applicable Secretary of State that provides the general partners with limited liability for the debts and obligations of the partnership. The LLP provides partners limited liability for tort, contract, and other acts that arise out of the business activities of the partnership, so long as the partnership maintains its LLP status. An LLP also limits a partner's liability arising from the professional negligence of the other partners. Now let's walk through the cost analysis, starting with entry costs. Unlike a general partnership, an LLP is a creature of statute, and therefore is more complicated and expensive to form, and requires that a filing be made with the Secretary of State. In addition, some states require that a written partnership agreement be executed and that an annual fee to maintain limited liability status be paid. Taxation costs, on the other hand, are limited. LLPs are pass-through entities for tax purposes, meaning that the business income of the partnership is taxed as personal income to the partners at their respective personal income tax rates. There is no income taxation at the entity level. Finally, LLPs typically incur higher capital costs because they do not have the same flexibility as corporations in admitting new stakeholders or transferring ownership interests. LLPs also lack the overall stability of corporations or limited liability companies. disagreements among the partners can easily cause the dissolution of the partnership. In addition, individual partners may commit the partnership to business agreements without the consent of the other partners. Now, all of these factors may contribute to raising the cost of securing outside capital. Partners in an LLP have a high degree of control over their business. The LLP structure allows the owners to customize how the business will be managed, and different partners may play different roles as in a general partnership. Often you'll see a managing partner who is in effect the CEO of the partnership, and other partners will have limited authority over the affairs of the business. There may also be a quasi-board of directors, similar to a corporation. Taking a look at the scorecard, we see that LLPs get good marks in 2 out of the 3 categories. With limited liability and high degree of control, we can see why LLPs are a very popular form of entity for businesses that do not have extraordinary capital needs. An LLP is a particularly good choice for a professional service business that requires a state license in order to operate, which is why we see groups of lawyers, architects, chiropractors, dentists, and MDs organized as LLPs. Now let's take a look at probably the most well-known form of entity, corporations. The corporation is a familiar and popular organizational form for both large and small businesses. Corporations are owned by stockholders who purchase shares of stock in the corporation. The corporation can be formed for the benefit of a single stockholder or for thousands of stockholders, as one might find in a typical publicly traded company. The majority of U.S. corporations are incorporated in Delaware because Delaware is very pro-business, and this is reflected in its corporate laws. Today's COE program focuses on the C corporation, which is the most common type of corporation. The S corporation is simply a corporation that has made a federal tax election, allowing it to avoid the double taxation to which corporations are normally subject. S corporations are typically used by smaller businesses due to limitations on the type and number of shareholders and on capital structure. After the successful completion of the incorporation process, the corporation is treated and viewed as a separate legal entity, which limits the liability of individual stockholders for corporate business activities and debts. As long as the corporation, its directors, officers, and shareholders observe and follow certain corporate legal formalities, the corporation will continue to offer limited liability to its stockholders. Generally, a shareholder's liability is limited to the amount of its investment in the corporation, regardless of any management participation. Except under exceptional circumstances, such as when piercing the corporate veil, a shareholder will not be held personally liable for the corporation's liabilities. Now let's walk through the cost analysis. As you can see, the breakdown is high entry costs, high tax costs, and minimal capital costs. Starting with entry costs, compared to other forms of entities, a corporation is relatively expensive to form and operate. The incorporator must prepare and file a certificate of incorporation and pay the applicable filing fee. Bylaws and other organizational consents must be prepared, typically requiring the hiring of an attorney. To establish equity ownership, share certificates must also be prepared. In addition, if a corporation is doing business in a state other than its state of incorporation, it must qualify to do business there, which causes the corporation to incur additional costs. With respect to the tax costs, the most commonly discussed disadvantage of a corporation is dual taxation. Dual taxation means, one, the corporation pays income tax on its profits, and two, shareholders are taxed on any dividends paid by the corporation. Unfortunately, shareholders cannot deduct any of the corporation's losses on their personal returns. One of the biggest advantages to the corporate form is the cost of capital. And without question, the corporation is the best entity to use for attracting venture capital. In fact, venture capital funds typically only invest in C corporations and do not invest in pass-through entities. In addition, shareholder recognition and comfort play a huge role in the ability to access outside financing. Investors are very familiar with the corporate form and understand how it affects their investment. The control analysis for a corporation can get a bit tricky, so we'll break it down into three categories. The first category I'll call transparency and governance, which is a positive control factor. Corporations benefit from clear and relatively standard default operational and governance structures. A corporation is composed of three different players: shareholders, directors, and officers. Shareholders have ownership rights and elect directors. Directors govern the general affairs and appoint officers, and officers manage the day-to-day operations of the business. In smaller corporations, it is typical for an individual to hold two or even three of these positions, thus exerting full control of how the corporation operates. Having such a clear governance structure makes controlling operations very straightforward. The second control category is also a plus in the control analysis and has to do with the transferability of ownership interests. The capital and ownership structure of a corporation is the most flexible out of all the entity choices. A corporation has access to a broad range of financial instruments, including common stock, preferred stock, warrants, convertible notes, etc., all of which are ownership interests and may be easily transferred from one party to another. The transferability of ownership allows corporate interest holders to easily enter or exit positions as they please. It also makes valuing that ownership interest very easy, as opposed to trying to attach a value to a general partnership interest, for example. The last control factor is a negative one and concerns the onerous corporate formalities and compliance requirements that corporations must adhere to. These compliance requirements are major disadvantages for businesses that need to make quick decisions. Some examples of the formalities that corporations must deal with include: 1, strict adherence to the corporate bylaws; 2, reviewing code sections that dictate how certain actions are to be taken; 3, maintaining separate books and records; 4, notice and voting requirements; and 5, keeping meeting minutes. If a corporate entity fails to observe and uphold corporate formalities, there are instances where the separate identity of the corporation will be disregarded, i.e., the corporate veil may be pierced. In the event the corporate veil is pierced, a corporation can and often will lose the limited liability protection afforded to its shareholders. Therefore, unless owners want to expose themselves to potential liability, corporate formalities must be strictly adhered to. The corporation scorecard is a bit mixed, with a very strong liability protection and some very strong cost and control characteristics intertwined with some not so strong cost and control factors. However, despite a mixed analysis on paper, in practice, the corporation is often the very clear choice for certain types of businesses. A C corporation is virtually the only choice for a business that requires strong liability protection and will be seeking venture capital financing in the near future. If the owners will initially be investing significant amounts of their own money and would like to write off losses, i.e. via a pass-through structure, then an S corporation may be considered. A perfect example would be a startup tech company that is looking to become the next social media success. As the startup will likely need angel investors, the corporate form will be their choice. Which brings us to our final form of entity, limited liability companies. A limited liability company is a type of unincorporated entity that offers liability protection to its owners. The LLC is the newest type of business entity and in many ways is an amalgam of other business entities. Some courts have referred to it as a hybrid of a corporation and a partnership, meaning it protects against personal liability like a corporation, yet has the flexibility and pass-through taxation status of a partnership. Despite being relatively new, limited liability companies are the fastest growing form of business entity. In many states, limited liability company filings exceed corporation filings. Now, as the name implies, members in a limited liability company are shielded from personal liability for the debts and obligations of the business, similar to shareholders in a corporation. The risk for the owners of the LLC is limited to their initial investment, and unless an owner has personally guaranteed a debt of the business, their personal assets are safe. Now, note that the name of the entity includes the word limited for a reason. Clients often believe that by incorporating a business, they will be protected no matter what. However, that's not the case. Members in an LLC are not necessarily shielded from wrongful acts, including those of their employees. Therefore, intentionally doing something fraudulent, illegal, or reckless that causes harm to the company or to someone else will result in liability. In addition, a few courts have held that an LLC that only has one owner, i.e. a single member LLC, is not protected against personal liability. Now, many times owners circumvent this danger by giving away a very small stake, say 1% or less, to a close friend or family member, and keeping in mind that it cannot be a spouse. The cost analysis for LLCs is very favorable. Starting with entry costs, although LLCs require more effort to form and maintain than a general partnership, the entry costs are generally less than that of a corporation. One or more persons may form a limited liability company simply by executing and delivering articles of incorporation to the applicable Department of State. Although recommended, an operating agreement is not required in most states, a notable exception being Delaware, which does require an operating agreement. Tax-wise, unless the LLC elects to be treated as a corporation, limited liability companies are pass-through entities for tax purposes, meaning that the business income of the LLC is taxed as personal income to the members at their respective personal income tax rates. There is no income taxation at the entity level. It should be noted that even if an LLC elects to be treated as a corporation for tax purposes, it is not forced to operate and adhere to the same formalities imposed on corporations. The one potentially negative factor in the cost analysis for LLCs is a higher cost of capital. Capital costs are typically higher because membership interests in an LLC are not as freely transferable as shares in a stock corporation. This substantially limits the flexibility of an LLC's capital structure. In addition, venture capital funds typically do not invest in pass-through entities, so an LLC would not be a good choice if outside investment is needed. However, I noted that the capital landscape for LLCs is changing, and the entity is becoming very popular as more investors become comfortable with the ins and outs of LLCs. LLCs have only been around a short while compared to corporations, so there is definitely room for the entity to grow and to be used more freely. The LLC form gives its owners substantial flexibility in controlling the business. An LLC can be either member-managed or manager-managed. In a member-managed LLC, the members have direct control over the business and directly participate in its management, similar to a general partnership. In a manager-managed LLC, members elect or appoint a manager to oversee the business, while the members have a more passive role, similar to a corporation. An LLC can also be operated similar to a sole proprietorship, with a single person being both member and manager. There are many permutations to dividing management responsibilities, which makes the LLC form extremely customizable. Another positive factor is that a limited liability company usually operates with far fewer formalities than a corporation. Having fewer corporate formalities means that the company can take action faster than other legal entities. The operating agreement can assign greater control over the company's management to some members over others, as well as differing allocations of profits and losses among the members. Taking a look at the scorecard, we see that the LLC form scores well in all three categories and has our best scorecard yet. In addition, the only negative, being higher capital costs, could potentially not exist in the future, or at least be only slightly negative. It's no surprise that the LLC form has been the fastest growing form of entity, and its popularity has been soaring. An LLC would be a good choice for a business that, 1, needs liability protection, 2, wants to avoid dual taxation, and 3, requires flexibility with respect to how the business is managed and allocations are made. And that's pretty much any business nowadays. Although there are many examples of businesses for which an LLC would be a good fit, just one example is a company that manages real estate, because each separate property can be owned by an individual LLC, thereby shielding each property from cross-liability. Now that means if there is a judgment against one property, it does not affect the other properties in the portfolio. So let's put all that information together and run through the top 5 takeaways from today's presentation. Let's see what we've learned from our business entity scorecards. Starting with sole proprietorships, they should generally be avoided due to the unlimited personal liability and high capital costs. Sole proprietorships are only worthwhile in very limited circumstances. General partnerships are similar to sole proprietorships and should generally be avoided. Often, general partnerships are entered into by accident, which can be problematic. Absent very specific circumstances, a limited partnership should generally be avoided by entrepreneurs due to the unlimited personal liability of general partners and to the complexity of the structure. Most of us are familiar with LLPs, having worked at law firms. It's a solid choice for the professional business. Next, a corporation should be the first choice for an entrepreneur who will be seeking outside capital financing. Although you have to deal with more compliance legwork, the liability shield is as good as it gets, which makes it worth it. And finally, because of their flexibility, tax benefits, and liability shield, LLCs are a very attractive option for many types of businesses, assuming venture capital financing is not needed. So that concludes our program. We have a few minutes for a brief Q&A. Meredith, have we received any questions via the chat function?
We have, and if you have any further questions, please send them in via the chat function on WebEx. We have a couple here that we want to try to get to, and if we don't get to any ones, then we will email that out to you after the fact. So the first question that we got was, what is the best form of entity to use for a startup that is being funded in whole or in part through equity crowdfunding?
Okay, well, that's a very good question. So for those that aren't familiar, the gist of crowdfunding is that someone has an idea and looks to finance the idea by attracting small amounts of money from a large number of people, and this typically happens via some kind of internet platform. Now, startups that are looking to utilize equity crowdfunding have a whole array of factors that must be carefully considered before choosing a business entity. Let's quickly break it down by going over the entity options that we covered today. So starting with sole proprietorships, since the very definition limits the ownership of a sole proprietorship to an individual, investors of any kind, including equity crowdfunding investors, are not an option. Therefore, sole proprietorships are out. Turning to general partnerships, we now know that each partner has joint and several liability for all the liabilities against the partnership. Therefore, it goes without saying that no business promoter in their right mind would capitalize through equity crowdfunding and take on complete strangers as general partners. With limited partnerships, while it's plausible that the general partner can take on each individual crowd member as a limited partner, thereby limiting the crowd's management and powers and their liability. The problem with full liability of the general partner remains, so therefore we can eliminate limited partnerships as well. Now, I know we didn't cover S-Corps in detail, but just for your information, the number of shareholders in an S-Corp is limited to 100. So unless the amount to be raised from the investors is small or the share price very high, use of an S-Corp is probably out of the question. Now, turning to limited liability companies, now we have a viable choice, but there are still pros and cons. On the positive side, unlike a limited partnership, an LLC provides liability protection from third-party claims for both management and investors alike. Also, like a partnership, it provides for pass-through taxation, which in general is a financial advantage. On the other hand, one downside to using an LLC is that it's not conducive to large turnover in ownership, which is a likely possibility with crowdfunding. Now, although the rules vary across jurisdictions, generally a high volume of ownership changes may force the dissolution of an LLC. In addition, members of an LLC must vote to admit new members, which could really slow the process. Another downside to using an LLC comes at tax time. It's possible and actually typical for a member's share of the profits of the LLC to exceed the actual amounts distributed. Now, accredited investors are accustomed to this when it occurs and, at least in theory, are able to absorb these types of costs. But a typical crowdfunding investor may be less sophisticated and in a more difficult spot financially and may be unable to absorb any tax liability in excess of amounts distributed. Finally, we have corporations, which is also a valid choice, but again has pros and cons. On the positive side, like LLCs, corporations provide great liability protection for both management and shareholders. In addition, since corporations are subject to double taxation, shareholders will only be taxed on the dividends they actually receive, which is at a preferential tax rate. On the other hand, while lower tax rates may be good for investors, it also means the business pays more taxes as a whole, and in turn, there may be less money to distribute to investors. Another negative for the use of a corporation is the requirement to hold annual shareholder meetings. Now, while the Jobs Act helps to simplify the process on a federal level, the Jobs Act does nothing to modify the general corporate law of each state. So you either have to pay for a place big enough to hold your shareholder meetings, and assuming your thousands of investors are willing to travel, or you will have to pay for the postage on thousands of meeting notices and ballots each year. So while your choice is pretty much limited to either an LLC or a corporation, the analysis can be tricky and ultimately depends on the specifics of the business idea and the estimated amount of investors.
All right. I think we might have time for one more short question. How does it work if I already have an existing business, but I want to convert it to an LLC?
Sure. So the details of how to convert to an LLC will vary based on a number of factors. And while we don't have time to look at all the possible scenarios, I'll give you a few basic facts about the general process. If your existing business is a sole proprietorship or a partnership and you want to convert to an LLC, most states provide a simple form called a certificate of conversion that you'll have to file with the applicable Secretary of State. Sole proprietorships and partners in states that don't provide a conversion form must file regular articles of incorporation to create an LLC. Also, in some states, before a partnership can officially convert to an LLC, it must publish a notice in a local newspaper that the partnership is being terminated. And lastly, in all states, you'll have to transfer all of your business's tax ID numbers, both federal and state, to the name of the new LLC. You'll also have to transfer any business licenses and permits. Now, keep in mind that the tax consequences associated with converting from a corporation to an LLC can be complicated, so please be sure to seek out additional guidance if necessary.
All right, well, perfect. Thank you so much for all of your time and your help on this, Rob. Unfortunately, we are out of time, but I do want to thank everyone for your time and participation on today's lunch break CLE. If we weren't able to get to your question, I know that there are quite a few still in the queue. We'll make sure and email you an answer shortly, so if you did not include your email with your question, please go ahead and send that to me now via the chat function. Please also feel free to contact me at LexisPracticeAdvisor, CLES, at LexisNexis.com, which is on your screen right now.